Imagine waking up, checking the charts, and seeing the entire crypto market sliding once again. Another red day, another gut punch. But today's drop isn't just another random dip. What we're seeing right now is the result of a perfect storm. One part panic, one part macro pressure, and one part regulatory fear. And if you think the volatility is over, it might actually be just beginning. Before we dive in, let me break it to you straight. The market fell 1.91% in the last 24 hours, pushing the 30-day decline to nearly 12%. That's not noise. That's a trend driven by fear, leverage unwinding, and uncertainty in every corner of the financial world. But behind these numbers, there's a deeper story about where Bitcoin, altcoins, and the entire crypto market could be heading next. Over the last day, nearly chucked $89 million worth of Bitcoin long positions were wiped out, accounting for roughly 80% of all liquidations. This wasn't just a few traders getting caught off guard. This was a wave of forced exits that accelerated selling pressure across the board. When leverage gets sucked out of the system this aggressively, prices don't just fall, they cascade. At the same time, crypto and equities tightened their relationship again, with the 24-hour correlation to the Nasdaq 100 hitting 0.69. That means crypto is moving almost hand in hand with tech stocks, and when risk assets pull back, crypto feels it twice as hard. Add to that the emotional side of the market, the fear and greed index crashing to 21, its lowest since November 2022, and you've got a recipe for panic-driven decision-making. Let's break down what's really happening behind the scenes. One of the biggest drivers of today's drop is what traders call a liquidation cascade. In the last 24 hours alone, Bitcoin saw over $89 million in liquidations, and almost all of them were longs. That means traders were betting heavily on the price going up, using leverage to amplify their gains and their losses. As soon as Bitcoin slipped under the critical $90,000 support level, it set off a chain reaction. Stops got triggered, margin got called, and highly leveraged positions got wiped out instantly. This wasn't a slow decline. It was fast, sharp, and mechanical. In fact, BTC liquidation surged 166% this week, which tells you just how fragile leveraged positions have become. Open interest in perpetual futures fell nearly 6%, signaling that a lot of traders weren't choosing to exit, they were forced out. When derivatives start driving price action this aggressively, the spot-to-perp ratio shrinks. Right now, it sits around 0.21, which basically means perp markets, not spot buyers, are steering direction. And that's when things get dangerous because price moves become exaggerated and unstable. If total market cap breaks below the 78.6% Fibonacci retracement level, around $3.04 trillion, we could see another wave of liquidations, potentially another $50 million or more flushed out of the system. So for now, the best word to describe this environment is fragile. But leverage isn't the only villain in this story. The macro environment is playing a huge role too. Crypto has once again synced itself with traditional markets. Over the past 24 hours, its correlation with the Nasdaq 100 jumped to 0.69 ecoxy, while gold sat much lower at Takri 0.43. That tells us investors aren't treating crypto like digital gold right now. They're treating it like a tech stock on steroids. What sparked the sell-off in traditional markets? A combination of nervousness around the Federal Reserve, stress building in the banking sector, and a surprising liquidity drain. The Fed pulled $25 billion of bank liquidity out of the system, which rattled sentiment everywhere, stocks, crypto, and even ETFs. Speaking of ETFs, Bitcoin ETFs saw $13.4 million in outflows, which might not sound catastrophic, but it's enough to tilt the balance when sentiment is already fragile. Here's the interesting part. Inflation expectations actually dropped from 4.5% to 4.1%, which normally should boost risk assets. But with the banking sector showing cracks and liquidity tightening, traders didn't want to take on more risk. So instead of piling into crypto, money moved out and prices followed. And then there's the regulatory cloud hanging over the market, which isn't helping investor confidence either. The SEC is once again pushing aggressively into the DeFi sector, signaling stricter rules, more scrutiny, and possibly new restrictions on decentralized platforms. Meanwhile, the CFTC has introduced additional oversight measures targeting crypto derivatives and trading activity. This 1-2 punch has created hesitation, especially among altcoin investors. It's no surprise that altcoins lagged behind Bitcoin, falling 1.84%, compared to BTC's 1.59%, while it's a weekly drop. Speculative trading has cooled dramatically, and the altcoin season index sitting at 21 confirms that capital is rotating away from alts and back toward Bitcoin. When regulatory uncertainty rises, money tends to flee risky assets, and smaller caps feel the impact first. So what does all this mean when we put it together? Today's drop wasn't about one single catalyst. It was the result of three major forces hitting at once: aggressive liquidation flows, risk-off sentiment from macro pressures, and renewed regulatory fear. Combine these factors with elevated open interest, still around $775 billion, and funding rates hovering around zero, and you've got a market that's vulnerable to sharp moves in either direction. Right now, Bitcoin's ability to hold the OXY $88,000 level is the line in the sand. If Bitcoin loses this support, the market could tumble further and fear would take full control. But if BTC holds the level and liquidity slowly re-enters, the market could stabilize and even recover once the forced selling is over. The next 24 to 72 hours are crucial. This is the part of the cycle where patience, discipline, and clarity matter more than emotion. Markets don't fall forever, but they also don't rebound until the weakest hands are flushed out. And a big part of that process is already underway. So as we watch these levels, keep an eye on three things: liquidation volumes, ETF flows, and macro headlines. These will tell us exactly when the market is ready to turn or when more turbulence is on the way. If you found this breakdown valuable, make sure to like the video, subscribe for more deep dive market analysis, and hit the bell so you never miss an update. The crypto market is moving fast, and having the right information at the right time can make all the difference. Stay safe, stay informed, and I'll see you in the next one.